This video is for educational purposes only and does not constitute financial advice. Always consult with a licensed financial advisor before making any investment decisions. What if I told you that everything you know about money is just the tip of the iceberg? Here's something you didn't know about how money really works. Welcome to Finance Simplified with Siva. Today, we're diving into the shocking truth about how money works. You'll discover some surprising facts that could change the way you think about your finances forever. Here's what you need to know about the origin of money. Did you know that money wasn't always in the form of coins and paper? It started as a system of bartering goods and services. Imagine trading a cow for a sack of grain. Over time, societies developed more standardized forms of currency, like gold and silver coins. This evolution made trade easier and more efficient. As trade expanded, the limitations of bartering became apparent. Carrying large quantities of goods was impractical, and finding someone who wanted what you had and had what you wanted was challenging. This led to the creation of money as a medium of exchange. Early forms of money included shells, beads, and even livestock. Eventually, precious metals like gold and silver became the standard due to their durability, divisibility, and intrinsic value. Now, let's dive into how modern money is created. Most people think money is just printed by the government, but that's only part of the story. Did you know that banks create money through lending? When you take out a loan, the bank essentially creates new money that didn't exist before. This process is called fractional reserve banking. Fractional reserve banking allows banks to lend out a portion of the deposits they receive, keeping only a fraction in reserve. For example, if you deposit $1,000 in a bank, the bank might keep $100 in reserve and lend out $900. This $900 can then be deposited in another bank, which keeps $90 in reserve and lends out $810, and so on. This process multiplies the amount of money in the economy, a concept known as the money multiplier effect. Central banks play a crucial role in our financial system. They control the money supply and interest rates to keep the economy stable. For example, the Federal Reserve adjusts interest rates to manage inflation and promote economic growth. But here's a twist. Their decisions can have far-reaching effects on your wallet. Central banks use various tools to influence the economy, including open market operations, reserve requirements, and the discount rate. By buying or selling government securities, they can increase or decrease the money supply. Lowering interest rates makes borrowing cheaper, encouraging spending and investment, while raising rates can help cool down an overheating economy. These actions impact everything from mortgage rates to the interest you earn on savings. Let's talk about the future of money, digital currencies, and cryptocurrencies. Bitcoin, Ethereum, and other digital currencies are changing the way we think about money. Unlike traditional money, cryptocurrencies are decentralized and operate on blockchain technology. This means they're not controlled by any single entity, making them both exciting and risky. Blockchain technology is the backbone of cryptocurrencies. It's a decentralized ledger that records all transactions across a network of computers. This transparency and security make it difficult to alter or hack the system. Cryptocurrencies offer benefits like lower transaction fees and faster transfers, especially for international payments. However, they also come with risks, such as price volatility and regulatory uncertainty. Governments around the world are still figuring out how to regulate this new form of money. Finally, let's explore the psychology of money. Did you know that your financial decisions are often influenced by emotions and cognitive biases? For example, the fear of missing out, FOMO, can lead to impulsive investments. Understanding these psychological factors can help you make better financial choices. Other common biases include the anchoring effect, where we rely too heavily on the first piece of information we receive, and the confirmation bias, where we seek out information that confirms our existing beliefs. These biases can lead to poor financial decisions, such as holding on to losing investments or overestimating our ability to predict market movements. By being aware of these biases, we can take steps to mitigate their impact, such as setting clear investment goals and sticking to a disciplined strategy. You won't believe the impact this one change could have on your finances. Stay tuned to find out. What's your take on the future of digital currencies? Let me know in the comments below. To sum up, we've uncovered some fascinating truths about how money works, from its origins to modern banking and the future of digital currencies. Remember, this is just the beginning of your financial education journey. If you found this valuable, consider subscribing for more educational content. What topic would you like us to cover next time? Drop your suggestions in the comments below. If you enjoyed this video, give it a thumbs up and share it with your friends. Don't forget to subscribe to Finance Simplified with Siva for more insights. See you next time.